Senior executives from the global reinsurance industry are gathering in Monte Carlo for the Rendez-Vous de Septembre. It's the first time the event's taken place in person since 2019, and there's plenty to discuss. I'm Richard Banks with AM Best TV, and I'm joined now by Bill Pieroni, Chief Executive of ACORD. Bill, welcome.
Richard, thank you for having me, and thank you and all of the AM Best colleagues around the world for everything you do for the insurance industry. You make a real difference in our ability to fulfill our mission and goals of protecting individuals and businesses around the world from risks and perils. So thank you for that.
But it's great to have you with us. The reinsurance market back together again, but it's facing a new set of challenges. How well do you think the insurance industry is set up to address the issues it faces?
I think you make an important point. A lot of things have changed, but at the core of what we do, and not to trivialize what the industry is, but we underwrite, we manage loss costs, we ensure that we've got meaningful relationships with insureds and brokers and agents, and round and round we go. So at the core of what we do is underwriting and claims and managing relationships and getting a decent investment return. But that being said, ACORD conducts countless studies throughout the year, and we've been doing so for several years. And we find that reinsurers and the reinsurance industry are some of the most highly performing and best positioned stakeholders within our industry. For example, we conduct a digitization study annually, and I think it's featured in several AM Best publications around the world, where we look at the top 200 insurers. Now, without going into too much detail, those top 200 insurers represent more than 75% of all the premium dollars. So it's just statistically valid sample size. Now, reinsurers make up about 5% of those 200 carriers, but they're over 25% of the most highly digitally mature carriers around the world. So specifically, when you think about digitization, how important it is, given the changes that you were referring to, reinsurers are extremely well positioned overall. Reinsurers are very disciplined in their underwriting and are very effective at managing loss costs and the use of data to do those things. And finally, I think we as an industry do not attract our fair share of high skill, high will talent. It's a real challenge for our industry, but reinsurers really do have some of the greatest talent around the world. So along many dimensions, reinsurers are extremely well positioned, especially vis-a-vis other parts of the insurance value chain.
So talking about digital maturity, you've talked in some detail in the past about the way that the pandemic has accelerated trends that were already underway. What particular lessons do you think the reinsurance industry can learn from the last 3 years as it responds to today's challenges?
I think, Richard, you're precisely right. The pandemic was a time machine that really accelerated everything, right, across the insurance industry, not only technically, but from process innovation as well as organization and strategic intent. I think the pandemic reinforced, as you intimated, everything that was already occurring. Clearly, digitization, which was already underway prior to the pandemic, really moved from something where the industry was investing into something that really turned out to be a critical source of advantage. When you look at those carriers that came into the pandemic with higher levels of digital maturity, we were fortunate that we've been doing this digitization study for over 5 years. So we had the data prior, during, and now a bit of after the pandemic. And what we found was that prior to the pandemic, there was a delta between those carriers exhibiting high levels of digital maturity and those with lower. However, even the laggards, as we call them, those with very little digitization, seem to perform reasonably well, below the average, but reasonably well. But what happened during the pandemic was there was a real divergence of outcomes. So those with higher levels of digital maturity went from, let's say, 10% better growth, combined ratio, share returns to 20, 30% better, whilst laggards who were average to slightly below average really suffered. And you can imagine if you didn't have the infrastructure in place to have colleagues interact 24/7, untethered from their homes, interacting with key stakeholders outside of a traditional workplace, you really saw a difference. Now, what's going to be interesting is, will the laggards be resilient enough to come back, right? Or is this a permanent impact to their overall outcomes? The challenge, I think, with digitization is that if you don't invest sustainably, you can't accelerate it. So the laggards, even if they had the resources, and that's just not money, but it's also talent, how do you accelerate it? You can't bake a cake in 5 minutes at 1,000 degrees. It's just not going to work. So there were some real challenges here. So I'll be interested in revisiting with you and your other colleagues at AM Best to see what it looks like in a year or two if this huge divergence persists, but it was material.
So you talk about laggards. How does that apply to perhaps new entrants as well? How do they fit into the digital maturity scope, as it were? So
new entrants many times lack the accumulated legacy. And I don't just mean IT. Clearly, IT, when you think about technology, it's the data, the software, the architecture, the infrastructure, but also business processes, cultures, organizational skill sets, measures, incentives. So new entrants, in theory, are unencumbered by legacy. However, one of the things that has bothered me about these new entrants is they somehow view it as a badge of honor that they have no prior experience in the industry. Now, look, there's a lot we can learn from new entrants. There's a lot we can learn from other industries. And I think we as an industry do a very good job at trying to learn to be innovative. But no legacy might, in fact, and oftentimes means no appreciation of what pricing cycles mean, natural and man-made catastrophes, regulatory regimes, what it really takes to underwrite effectively, why prices are there, reserving, all of that. So I think in some respects, new entrants with clean balance sheets and the ability to invest in capabilities, tabula rasa, have some source of advantage. But I do worry about the lack of perspective, maybe, and experience overall.
Bill, in general, the reinsurance industry seems to be in reasonable health. Earnings seem to have bounced back. But how sustainable are those earnings, do you think? And where does the industry need to focus in order to prepare for the future?
So, Richard, one of the studies we do, and we've been doing this now for decades. I've been doing this study for over 20 years. We look at value creation in the property and casualty industry. And without going into too much detail about how we do the analysis, it's essentially a free cash flow model. Carriers hold a certain amount of capital in surplus and claims reserve, and we assign a cost of capital to each one of those carriers, and we determine whether or not they generate enough cash flow. Now, when you dig into that cash flow, there are two sources of cash for a carrier. There's underwriting cash flow. In other words, you price the product appropriately when you take out all the underwriting expenses, commission, general expense, management expense, taxes, license fees, plus loss cost, the loss adjustment expense, plus pure loss, indemnity cost. Did they generate a positive free cash flow? So what we do is we segment carriers, and we've done this study all around the world, into sustainable value creators, hollow value creators, and value destroyers. Sustainable value creators generate their required cost of capital both through investment as well as underwriting. Hollow value creators generate enough cash flow, but only through investment. They actually destroy value through underwriting, whilst the value destroyers don't earn their cost of capital. Right? So when you say how sustainable is it, I think it reminds me of our study. If you underwrite appropriately and don't solely rely upon investment returns are important. Sometimes they rival underwriting returns, especially with longer-tailed products like many reinsurers sell. But if you invest appropriately in underwriting capabilities and really maintain a discipline, your results are in fact sustainable, because regardless of what's going on with currency, capital markets, bond market, real estate liquidity or marketability challenges, you are going to do well. And specifically, reinsurers are some of the most disciplined underwriters globally. They understand the importance of making an underwriting profit and being thoughtful about pricing and maintaining discipline in foregoing growth in order to achieve an underwriting profit. So I think for the high performers, for the sustainable value creators, their results are going to continue on. and they're going to continue to gain share. And we will see a flight to quality if and when the market begins to perhaps soften a bit.
Well, before we move on to a softening market, people are starting to talk in terms of a genuine hard market at the moment. And I guess very few participants will have actually operated in those conditions before. Who will be best positioned, do you think, to benefit from a genuine hard market? And what should we be looking out for? Where might the surprises come from?
So when I think about who's going to benefit, I go back to my argument around sustainable value creators. In a rising market, all ships will rise. So everyone will do well, right? I think the surprises can occur when capital markets weaken and those investment returns that I said perhaps disappear, when there's challenges around the investment portfolio. I do worry a bit about alternative capital, because as returns rise, if we think about Keynes' invisible hand in all of this, it will draw in more capital. And today, right, insurance-linked securities, the alternative risk transfer marketplace, formation of captives, there's lots of opportunities for capital to flow into our industry, particularly reinsurance, without necessarily being explicit reinsurers. So when I think about where the surprise is, if you rely too much heavily upon investment returns, you could be surprised. I do think that the strengthening of the US dollar is going to be something that could maybe take investors by surprise. I know our industry is very much watching this. So if you're a US-based carrier, right, with far-flung global operations, as those foreign, depending how you price those policies, come back, it's going to have an impact on your earnings. If, on the other hand, you're a European or Asian-based reinsurer and you do a great deal of business in the United States, your locally denominated earnings statements may be very, very attractive to you. So I do worry about the US dollar strength and what it's going to do, because oftentimes carriers won't hedge currency, right? It's just accepted. Now, for those who've hedged it, it's not going to have a positive or negative effect. But those who are unhedged with these policies, and depending on how loss costs are paid for, to be very thoughtful about this. We've seen wide swings when you look at the British pound losing significant amount of value this year, and also the euro at near parity with the US dollar, and on and on. And I don't think that's going to go away anytime soon. I'm certainly not predicting what's going on with the macroeconomy or the federal bank within the United States, but I think the dollar's strength will continue on, which has good and bad news. It's very mixed, and it could catch people off guard and may surprise earnings.
That's fascinating. What does that tell us about the ability of the reinsurance industry to remain a global industry, do you think?
So I know you didn't know this, so you aren't setting it up. We're just completing a global study, and we looked at scale and scope. In other words, scale, how much premium are you writing, and scope, products, customer segments, geographies. And I don't want to give away a lot of the study, but I have to say what we found is that large global carriers actually achieve average performance. Being bigger is a good thing in that it dampens volatility of performance. It's a bad thing that it appears to limit strategic and tactical degrees of freedom around superior performance. As you move away from the extreme levels of scale and scope to smaller carriers, you have much higher volatility about the mean, with significant numbers outperforming the market, but then significant carriers underperforming. And we're really digging into it, but without giving too much of my study away because it hasn't been published yet. What we found is that the common thread is data, and how data is gathered, aggregated, synthesized, analyzed, and then driven down. So larger carriers, in theory, have economies of scale and scope around data and insight, but their size appears to somewhat limit how effectively it can be used to drive outcomes and optimize decision-making, really that predictive analytics. On the other hand, smaller carriers Some of them are very effective with local knowledge and deploying that for growth, share, and sustainable economics, whilst others perhaps are lacking in informational scale and scope. So we're nearing the completion of the study, but I think it's an interesting dynamic because intuitively we think scale matters, right? Productivity of colleagues, buying economies, informational spillover, pricing umbrellas, relationships, brand. There are so many sources of scale advantage. Now, the one thing that benefits scale in the reinsurance industry is balance sheet. So reinsurers who are global, by their very nature, it's almost axiomatic, are bigger, have bigger balance sheets, can take on risk, can take on positions that others can't. So it's clearly a source of advantage. But please look forward to that study. It'll be published very soon. But I think the reinsurance industry will remain global. I think that reinsurers are very good at using data. We can always get better at it. And investment in data analytics capabilities to drive that insight to the moment of value. And the moment of value is when you're binding a treaty or a facultative policy, when you're managing loss costs, when you're dealing with customer issues and opportunities. It moves from asking the question, what happened, to what's the best thing that can happen? How are you forecasting, predicting, and driving? And I think that is going to be the real source of advantage moving forward. Just being big means that you'll be average. How do we, as a global industry and for our larger constituents here, how do we use that scale to advantage, minimizing the diseconomies of scale, the bureaucracy, the frictional costs, the cultural issues that can occur, and then how do we benefit, right, from that scale and scope? And it's a real challenge here.
Well, we will wait for that research impatiently, Bill. It sounds absolutely fascinating. And meanwhile, thank you very much indeed for all the insights you've shared with us today. Plenty to think about there for all of the executives who are heading down to Monte Carlo and gathering there for a week of discussions. Thank you very much indeed for joining us.
Thank you, Richard.
For more coverage of the Monte Carlo Rendezvous and a host of related insights, visit ambest.com. For AM Best TV, I'm Richard Banks.